How's it going, everybody? Welcome back. Today we're going to be diving into a topic that can impact your wallet and your financial future, which is the Fed's potential rate cuts. So what's happening? Mark your calendars, because on November 7th is the next big date that the Federal Reserve will be essentially having a meeting to decide whether they're going to cut interest rates before the end of the year. According to the FedWatch tool, a rate is highly likely. The only debate is if they're going to cut the interest rates 0.25% or 0.5%. Right now, the data suggests that a 0.25% cut is mostly the outcome. This move would bring some relief to borrowers, but it's also a sign that the Fed is being cautious. They don't want to cut rates too quickly and essentially risk undoing the progress that they've made controlling inflation. So the question is, why not a 0.5% cut? For the Fed to consider such a drastic move, we need some clear signs that the labor market, the stock market, and essentially the broader economy is struggling. As of right now, all these indicators are relatively strong. Unemployment is still low. Companies are reporting solid earnings. Economic growth, while slower than last year, it's still steady. Now, don't forget that the Fed is having another meeting in December 18th where the Fed will reevaluate the situation. As things stand, there is a good chance that the Fed will make another rate cut, 0.25% at that time. And if that happens, the Fed funds rate would be sitting, I think it was at a 4.5% by the end of the year, which is a significant drop from the peak rates that we saw earlier in this essentially tightening cycle. But here's a big question, right? So what does this mean for you? Why do rate cuts matter to you at the end of the day? And here's where it gets personal, okay? While the Fed rates aren't the same as the interest rates on your mortgage or car loan, they are closely connected when the Fed cuts its rates. So when the Fed cuts its rates, it usually triggers like a domino effect. Think of it this way: the lenders adjust their rates on everything from mortgage to credit cards, and to be honest, even your high yield savings accounts. So if you're looking to refinance a mortgage or take out a loan or pay off debt, a rate cut could be good news for you. Lower interest rates essentially means cheaper borrowing costs, and for those who are refinancing, it could mean a significant savings over time. On the flip side, savers beware. It's not all good news. If you're a saver and you have a high yield savings account, you definitely want to pay a little bit of attention to this, because what that means is when the Fed cuts their rates, also you start to get lower interest on your high yield savings accounts. So your high yield savings accounts could also potentially drop their rates as far as what you get. Over the past few years, the high yield savings accounts have been offering pretty decent interest rates as the Fed's kept its rates high. However, as the Feds start to lower the rates, you might see those APYs drop as well. That means that your savings could earn less potentially over time. So I know for those who have a lot of money in your high yield savings accounts, if you rely on your savings accounts for interest income, now might be a good time to shop around for accounts that offer better rates, or essentially consider diversifying into relatively safe options like CDs or short-term bonds or other things that you can do to essentially grow your money over time. So I know for some of you this might seem obvious, but why does the Fed cut rates? I want to take a step back as to why the Fed is cutting rates in the first place. So the Federal Reserve controls a short-term interest influence to the broader economy. So when inflation gets too high and they raise interest rates to slow down spending and borrowing and all these other little factors. But when they feel like inflation is kind of under control and the economy needs to get a little boost, they start to cut rates to encourage like borrowing and investing. The overall goal is to keep kind of the economy balanced, something that's not too hot and not too cold. And right now, they're walking kind of a fine line between inflation and preventing an economic slowdown, right? So how can cutting interest rates impact the market? So the stock market often reacts positively to rate cuts because lower rate cuts generally means companies can borrow more money cheaper, which at the end of the day increases their profits, right? So, however, there's always a catch, right? So if the Feds cut rates too aggressively, it can signal that they see trouble on the horizon, such as weakening growth or rising unemployment. And for long-term investors, it's crucial to remember that the Fed cuts rates are just one piece of the puzzle, right? So stocks tend to perform well over time, and if you're investing in short term, it might be smart to kind of keep an eye on the markets and how they react to these cuts. For the most part, there's not much that we can do as the Feds either raise or cut interest rates. But during these rate cuts, how can you prepare? So there's a few tips that we can kind of take into consideration. One, if you have debt, as the rates start to cut, you can refinance it. If you have loans, especially mortgage or student loans, it can be a good time to kind of consider refinancing, because at the end of the day, lower rates can save you thousands of dollars over time of that life of the loan. So another thing we can do is kind of review your high yield savings accounts. If you're relying on that as a major source of income, definitely take a look at other avenues that you can be essentially using to increase your wealth over time. Shop around. I'm going to make another video with high yield savings accounts that are offering the best rates right now. So definitely subscribe and hit the bell notification. That way you get notified when I drop these videos, because you definitely don't want to miss it. I'll be doing the hard work for you as far as doing the research. So definitely subscribe and like this video if it's helping you out. So another thing we want to do is invest wisely, right? If you're in the stock market, remember that while rate cuts can be a good for stock markets in the short term, they're often a sign that the economy might be slowing down a bit. So definitely diversify your investments. That can help manage risk at the end of the day. There's nothing to be worried about. Obviously, rate cuts are better for us all. So definitely just stay calm if you're freaking out. The economy right now, everything's showing that it's pretty strong. Although some of us are still kind of struggling and still feeling the stress of the last couple of years, it might start to be getting better. So definitely just hang in there, hold your head up high, and just stay strong. So my final thoughts are, as we approach these upcoming meetings, it's essentially to stay informed, right? So these rate cuts may seem like another piece of financial news, but they can have a real impact on your personal finances. So whether you're a borrower, a saver, or an investor, make sure that you're paying attention, because it can definitely impact you. So make sure you hit that subscribe button, turn on your notifications. That way, every time I drop a video, as these things start to unfold, you get updated. Thank you guys for watching. I appreciate all the support. Until next time, love you guys all. Peace.